Hello and welcome to the DIY Investing YouTube channel. Today we are working through every company in the S&P 500, and today is Archer-Daniels-Midland Company, ticker ADM. Over the next 5 minutes, we will go over both the valuation of this company and my thoughts on the business quality. Let's dive right on into the numbers using quickfs.net. So this is a company in the food products industry, and if we look at the business description here, we can see that Archer-Daniels-Midland procures, transports, stores, processes agricultural commodities. So again, we already knew that they're in the food. They have ag services, oil seeds, carbohydrate solutions, and nutrition. So they produce, store various different raw materials. Along those lines, it sounds like they have a decent distribution business. And so that kind of gives us an overview of what they do. It doesn't really tell me a lot, but they are involved a lot with commodities. Maybe that gives them pricing power, maybe not, but it looks like they maybe have some cyclicality. So when you go into the return on invested capital, the first thing that sticks out to me, besides the cyclicality, is that they have 20 straight years of profitability. That's always good. In order to have a positive number here for return on invested capital, you have to be profitable. So they have 20 straight years of profitability. That is a big plus for the quality of the company. However, something I don't like is this is return on invested capital. I like to have this number above 10%. And we can see that only once over the last 20 years did they have a number above 10%. And the remaining time, they were more in the 3 to 6% range, 3 to 5%. Relatively low numbers. They were not often even near 10%. And you can also clearly see with your eyes this is a cyclical company. So cyclicality is normally bad for a quality assessment, but we'll get on further into that. Now, return on invested capital is only one piece. What I really care about is return on equity, and I like to see a return on equity number above 15%. That gives me some assurance that I can achieve high returns in the 10, 15, 20% range. I need this number to be above 15%. Now, it's at 9%, which means it's going to be very hard to earn a good return owning this company over the long term. So 9% is not good. And this 3.9% and 6.2% are also not good. So we're going with a negative so far on business quality, but maybe we'll have a good valuation. So valuation is at 18.9. That's reasonable. Depending upon the growth rates, depending upon what it is, you can make a good case for PE ratios in this range. You're talking about a 5% plus earnings yield, still relatively low, but it could be justified with the right amount of growth. However, that growth is relatively low. You have earnings per share of 4.3%. And what's not being seen here is that although this is earnings per share growth of 4.3%, you're going to have to put a lot of your investment reinvesting into it. So I would assume there's not a huge dividend being paid. There might be a small dividend being paid, but you're being hampered in your amount of growth because you're going to have to reinvest a lot of that money. If your return on capital was higher, you would have less investment requirements in order to achieve this growth. So the combination of this and the growth means it's maybe acceptable on valuation, but these numbers tell me it's really bad on terms of quality. Now, don't forget to like this video and hit that subscribe button below so that you can get updates as I put out new videos. So let's dive on into the income statement. Can give us a little bit more information. So what you can see here is the revenue has declined over the last year. Actually, that would be really easy. Let's go back to here. So revenue has grown slightly, 0.6%. Assets are growing faster than revenue, which is normally a really bad sign. And now let's go back to that income statement. So the income statement, you can clearly see this revenue kind of growing, kind of not. And your cost of goods sold have allowed you to actually grow your gross profit over time. So despite your revenue being relatively flat, gross profit has grown. And your operating profit has grown, but it's not grown a lot. What I like to see here, though, is we go down to shares outstanding. We can see that the company has been executing buybacks. I always like buybacks. They seem to make the companies more attractive, and it's part of why earnings per share has grown faster than the net income and the operating profit because they have bought back shares. When we go to the balance sheet, we can see a little bit more. You can see that their property, plant, and equipment has been relatively stable. That's a good sign. It has grown some, but it's not grown a ton. Your assets have grown steadily over time. Is there some goodwill here? There is some goodwill. So you can see that they've made some acquisitions. They maintain a lot of inventory. That's $12 billion of inventory, $14 billion of inventory. So that's a big portion here of those assets. Now, are they raising debt? So debt's been relatively flat. So a lot of just stuff that's okay here. Nothing leaps out to me that says, hey, I want to buy this company. They're not growing fast. They don't have high returns. they're just kind of okay. I mean, you see cash flow from operations, not even positive every year. You have actually negative. How many straight years of negative? 5 straight years of negative cash flow from operations. This is a huge red flag. Huge red flag without diving into it. Now, a lot of this is change in working capital, but it's very concerning that for 5 straight years they had negative working capital. So I have a lot of concerns about this business. I would not invest in this company. For me, ADM, Archer-Daniels-Midland Company, is a pass. It's a pass on quality because these numbers are simply too low. It's also a pass on valuation because although the valuation is reasonable, it's not cheap. And for something with these level of returns, I want to buy this company cheap. I want to buy it below a PE of 10, certainly, maybe much lower than that because it's not really growing and it doesn't have the return on equity in order to justify high growth. So for me, pass on valuation, pass on quality. It won't hit my watch list. Hit the like button on this video, hit that subscribe button, and don't forget to ring the bell so you get updates as I upload new videos. Thank you for listening, and until next time, stop paying fees, start building wealth.